Over the years, our politicians have allowed foreign countries to take our jobs, harm our workers, and target American industry and agriculture. The repercussions were unforeseen, but the situation has drastically deteriorated in the heart of American farming. President Trump's new tariffs have backfired significantly. John Deere closed U.S. plants, laid off thousands, and shifted production to Mexico. Meanwhile, other nations swiftly filled America's void while protests erupted among farmers and workers across the U.S. In today's video, we delve into how one company's actions led to the downfall of a $34.5 billion business, highlighting why American farming faces an uncertain future. The decision to move production to Mexico was more than a corporate strategy. To boost efficiency, it felt like a betrayal to many who contributed to the company's global success. For workers and farmers, it was a sudden loss of support. To grasp why this issue became so charged, consider the timing and reactions. News broke of John Deere's U.S. plant closures and Mexican relocation, justified by the need to cut costs and compete globally. While Deere assured its commitment to American manufacturing, this reassurance fell short for many. Former President Trump condemned the move, accusing John Deere of outsourcing and threatening hefty tariffs. His proposed 200% tariff on foreign-made Deere equipment resonated politically, rallying his base of farmers, factory workers, and small-town Americans who felt betrayed. Trump's tariff proposal sparked debate in both political and corporate arenas. While it appealed to his supporters, economists and trade experts cautioned against its potential to harm American farmers and escalate trade tensions. While tariffs can pressure companies to bring jobs back to the U.S., they often come with unintended consequences, chief among them higher prices. If enacted, a 200% tariff would significantly increase the cost of tractors, harvesters, and spare parts, vital equipment for farmers already struggling with inflation, soaring fuel prices, and unpredictable crop yields. Ironically, the very people Trump aimed to protect could end up bearing the brunt of these policies. Meanwhile, across the border, newly elected Mexican President Claudia Sheinbaum Pardo addressed the controversy with a calm but firm message. She stressed that North America's economic strength depends on cooperation, not conflict. Rather than retreating into protectionist measures, she advocated for regional collaboration to build a more resilient, tech-driven, and inclusive economy. Her administration recently introduced an economic plan offering up to 30 billion pesos in tax incentives for companies investing in high-value industries in Mexico, precisely the kind of support that made John Deere's move appealing. For Mexico, John Deere's investment is a strong signal of confidence in its workforce and industrial future. But for American workers, the view is starkly different. The move feels like a deep loss, a painful reminder of shifting priorities in global trade. The broader backdrop is also complex. Despite the U.S.-Mexico-Canada Agreement, USMCA, promoting fair trade, tensions have been rising, especially over disputes related to energy, labor, and manufacturing standards. The relationship between the U.S. and Mexico has grown more strained. Sheinbaum's diplomatic tone is a sharp contrast to Trump's aggressive stance. But both leaders are reacting to domestic pressures, Trump to voters demanding job repatriation, and secure supply chains, Sheinbaum to the promise of industrial growth and foreign investment. These conflicting goals create a difficult balancing act, and corporations like John Deere often find themselves in the crossfire. To some, John Deere's move is just part of a larger trend, businesses restructuring globally to remain competitive. But to others, it's a breaking point. In many rural communities, John Deere wasn't just a company, it was part of the cultural and economic fabric. The brand supported schools, sponsored events, and offered stable jobs that spanned generations. That's why the closures feel so personal. They're not just economic losses, they're emotional wounds. At the same time, it's essential to understand the broader forces at play. Global competition, volatile commodity prices, and rising raw material costs are all putting pressure on companies like John Deere to make hard choices. While shifting production to Mexico might reduce expenses, it brings its own risks. Complicated logistics, regulatory hurdles, and backlash from a loyal customer base. For many farmers, the initial reaction was disbelief. They had spent years paying premium prices for John Deere equipment, believing they were investing in American craftsmanship and values. Now they're left questioning whether that loyalty was misplaced. Farmers didn't just view John Deere as a brand, they saw it as a trusted partner. So when that partner chose to shift jobs overseas, the sense of loyalty quickly turned into deep frustration. For many whose livelihoods rely on agricultural equipment, the decision felt like a profound betrayal. It wasn't just about lost jobs, it was about a perceived abandonment of an entire way of life. In small towns across America, the conversation changed. Coffee shops, co-op meetings, and hardware stores that once buzzed with talk of weather patterns and crop plans were now filled with questions about what to do next. Farmers began to organize. Some launched online boycott campaigns, while others took symbolic action by painting over John Deere logos on barns, silos, and equipment. These acts sent a clear message. The trust they once had was broken, and brand loyalty was no longer a given. But the anger didn't stem solely from the outsourcing decision. Many farmers had already grown increasingly frustrated with John Deere's restrictive repair practices. Over time, the company had locked more of its equipment behind proprietary software and exclusive diagnostic tools. That meant even minor repairs often required going through official dealers, leading to expensive service fees and costly downtime, especially during critical windows like planting or harvest. This lack of repair freedom became a central issue in the growing right-to-repair movement. Farmers argued that if they owned a machine, they should have the right to fix it. But Deere's software restrictions made that nearly impossible without special access, effectively shutting out independent mechanics and making do-it-yourself repairs more difficult and risky. As a result, resentment built steadily over the years, and the outsourcing announcement only poured fuel on the fire. In this climate, many farmers started looking elsewhere. Brands like Kubota, KIH, and AGCO, which includes Massey Ferguson, began to gain serious ground as farmers sought alternatives to a company they no longer felt had their backs. For a growing number of rural Americans, the John Deere legacy was no longer a source of pride, but a painful reminder of promises unkept. Some of these rival companies, many of which had more open and flexible repair policies, suddenly found themselves in a much stronger position. Farmers who once swore by John Deere were now willing to explore alternatives, especially those that appeared more aligned with their values and more supportive of domestic labor. But the backlash wasn't limited to the farming community. Workers inside the soon-to-be shuttered John Deere plants felt equally abandoned. For employees in places like Waterloo, Iowa, and Moline, Illinois, these factory jobs weren't just well-paying. They were the economic backbone of their communities. Generations had built their lives around the stability these positions provided, so when layoffs were announced with little warning, the shock hit hard. It came at a time when inflation was already straining families and alternative employment. Options in many rural towns were scarce. For many long-time employees, the closures felt like a betrayal. They had stayed loyal through downturns, worked overtime, accepted compromises, only to be told their roles were no longer needed. The emotional response was immediate. Protests erupted at multiple John Deere facilities, with workers holding signs like, "Deere sold us out," and "We built this company." Picket lines formed, and the community rallied around them. It wasn't just about jobs. Local businesses, from diners and salons to auto shops and grocery stores, began to feel the sting as the economic ripple spread. The United Auto Workers, UAW, and other labor unions moved quickly. They condemned Deere's decision as a clear example of corporate greed, accusing the company of putting shareholder profits ahead of American workers. Union leaders demanded immediate government action, calling for penalties against companies that offshore operations while remaining profitable at home. Some even proposed legislative measures to disincentivize outsourcing. To the workers, it wasn't just about losing their income, it was about losing identity, pride, and legacy. Many had hoped their children would one day work the same factory floors. That dream was now shattered. What made the situation sting even more was that John Deere was not in financial trouble. On the contrary, the company had recently posted strong earnings and continued to reward executives and investors with sizable bonuses. To laid-off workers and disillusioned farmers, this was salt in the wound, proof that the decision wasn't driven by necessity but by profit optimization. Meanwhile, the response across the border couldn't have been more different. Mexican. President Claudia Sheinbaum Pardo welcomed Deere's move, seeing it as a key win in her broader push to make Mexico a global manufacturing powerhouse. Her government had been actively offering tax incentives and upgrading infrastructure to lure foreign investment. For Mexico, John Deere's shift was a strategic opportunity to boost job creation and economic modernization. A success story in the making, but to elevate Mexico's technological and industrial standing. Her message was clear. Mexico is open for business. And while Sheinbaum expressed a desire to maintain healthy trade relations with the United States, she also made it known that Mexico would act in its own economic interest. The tone marked a break from previous administrations, more assertive, more strategic, and it positioned Mexico as a rising pillar in the global manufacturing supply chain. Back in the United States, however, the human cost of that transition was impossible to ignore. As protests swelled and boycotts grew, John Deere's once pristine image began to fray. Once considered a symbol of American grit and rural reliability, the brand now stood accused of abandoning the very people who had built it, both figuratively and literally. Alternative manufacturers gained traction. Union support intensified, and Deere was no longer just facing economic headwinds, it was facing a crisis of identity. The move to offshore production ignited a broader reckoning. What is the future of American manufacturing and agriculture? Can companies be globally competitive while remaining domestically accountable? Should there be incentives for staying or penalties for leaving? And what role should the government play in defending working-class communities from corporate decisions made far from the factory floor? As plants closed and production lines relocated, the ripple effects across the American agricultural economy were swift and punishing. For farmers already dealing with paper-thin margins, unpredictable weather patterns, and inflationary pressure, the Deere exodus was the beginning of a downward spiral they were not prepared for. One of the most immediate impacts, a sharp spike in equipment prices. With fewer machines being produced in the U.S. and tariffs looming, or already implemented, on foreign-built machinery, prices surged. A tractor that might have cost $60,000 just a few years ago was now priced north of $100,000, and that was just the entry-level model. Maintenance costs, replacement parts, and mandatory software subscriptions compounded the financial burden. Small and mid-sized farms, already operating on the edge, were hit hardest. These family-run operations rely on spreading costs over several seasons, and many found themselves completely priced out of the market. As a result, fewer farmers could afford to replace aging equipment, and old machinery means more breakdowns, less efficiency, and greater risk of missing narrow planting and harvesting windows. Each one a missed opportunity, a reduced yield, a hit to income. The used equipment market, once a safe haven, quickly overheated. Demand surged and prices followed. Machines a decade old or even older were selling for near-new prices. In some cases, farmers were forced to buy equipment older than what they were trying to replace, and repairs weren't any easier. With Deere's proprietary software still locking farmers out of their own machines and the supply chain now stretched across borders, repair delays became commonplace. Parts that once arrived in days now took weeks. Customs checks, international shipping congestion, and rising fuel costs all added time and money. Every extra day, waiting on a repair was a day of uncertainty, and often a day of lost profit. As if that weren't enough, financing became another uphill battle. Rising interest rates made borrowing for equipment, seed, or land improvements far more expensive. Banks, increasingly wary of instability in rural markets, tightened their lending standards. Some farmers were denied credit altogether. Others were forced into predatory terms, and so the squeeze tightened. Faced with rising costs, limited support, and shrinking margins, many small farmers were left with impossible choices. Some scaled back acreage, others let go of seasonal workers. A growing number saw no way forward at all, and sold out. Often, that land didn't go to other family farmers. It went to large agribusinesses or foreign investors. This wasn't just a business trend, it was a transformation. The economic fabric of rural America, already fraying, was now unraveling. And John Deere, once a thread that bound these communities together, had become, in the eyes of many, the knife that cut it loose. The consolidation of farmland had been unfolding for decades, but the crisis triggered by soaring equipment costs and global supply chain breakdowns turned a slow burn into a wildfire. Family farms that had weathered countless storms, economic and literal, were now selling off at an alarming rate. And while rural communities braced for impact, John Deere was already looking ahead. The company bet big on automation and smart farming technologies. Autonomous tractors, robotic harvesters, AI-powered crop monitoring systems. Deere executives touted these innovations as the key to a more efficient, more sustainable agricultural future. And, in a technical sense, they were right. The capabilities were remarkable. Self-driving tractors could operate 24/7 with precision. Drones could scan hundreds of acres in minutes, analyzing plant health, soil moisture, and pest activity. Software platforms provided hyper-detailed guidance on irrigation, fertilization, and yield forecasting. Decisions once made by instinct and tradition, now handed over to algorithms. But in practice, this future wasn't built for everyone. It was built for those who could afford to buy in. A single autonomous tractor could cost upwards of $500,000. Software platforms came with subscription fees, mandatory updates, and proprietary lock-ins that limited compatibility with older machinery. Farmers couldn't just upgrade one part of their operation. they had to overhaul everything. And for most family farms, that simply wasn't possible. This ushered in a new, deeper divide in American agriculture. On one side were the large agribusinesses, corporate-owned megafarms with access to capital, teams of analysts, and fully integrated tech ecosystems. On the other were the traditional family farms, stuck in a widening gap between outdated tools and unaffordable innovation. Automation, hailed as a solution to farming's toughest challenges, often felt like another hurdle. Worse, it replaced jobs. Where once a crew of workers was needed to run machinery, now a single operator with the right software could do the work alone. It was great for the bottom line, but devastating for local employment. In many small towns, these jobs weren't just income, they were community anchors. Without them, populations declined, schools shrank, and local businesses withered. And just as farmers adjusted to technological disruption, the global markets shifted beneath their feet. Overproduction in countries like Brazil, Argentina, and India created a surplus of key agricultural commodities, corn, soybeans, wheat. As global supply outpaced demand, prices plummeted. For American farmers already choking on high input costs, this was catastrophic. Corn prices dropped more than 35% in just 2 years. Soybeans and wheat followed closely behind. For farms that had taken on loans to finance new equipment, fuel, or land, the crash was a death sentence. Many couldn't even break even. Desperate, some farmers tried to compensate by planting more, hoping that sheer volume might make up for lower prices. But that strategy quickly backfired. More acreage meant more fuel, more fertilizer, more labor, costs that ballooned faster than any potential revenue. Others tried scaling back, but that had its own consequences: smaller yields, lost contracts, and forfeited positions in supply chains increasingly dominated by the biggest players. It was a no-win situation. And in many places, the old rules of resilience, work hard, tighten your belt, wait out the storm, no longer applied. It was a lose-lose situation for many farmers. Through it all, government assistance remained patchy and inadequate. Crop insurance could only cushion so much. Federal subsidies were frequently skewed toward industrial-scale operations or tied up in layers of bureaucracy. Emergency relief programs arrived too late or failed to address the root causes of the crisis entirely. Calls for broad agricultural reform grew louder, but in Washington, meaningful action remained elusive. In the eye of this economic storm, many farmers began asking a question once unthinkable: how much longer can we keep going? Generational farms closed down, some after more than a century of operation. Rural schools shrank as families moved away. Local businesses that depended on a strong farming base, feed stores, tractor repair shops, diners, shut their doors. The land was still there. The machinery still ran, the knowledge still passed from parent to child. But the financial foundation had crumbled, and as the United States faltered, others were quick to move. The EU makes its move. The first decisive action came from Europe. European Union leaders recognized a rare window of opportunity. With US agriculture in disarray, the EU could strengthen its own farming sector and compete globally. Within months, a wave of subsidies swept across member states. France, Germany, and Spain led the charge, injecting billions of euros into their domestic agricultural economies. These funds were directed towards sustainability initiatives, crop insurance expansion, and modernizing equipment, everything small and mid-sized producers needed to stay competitive. At the same time, the EU imposed strategic trade restrictions on US imports, particularly corn, soybeans, and wheat. These new tariffs and standards were framed as consumer protections or environmental policy, but few doubted the underlying motivation: protect European farmers and shrink US market share. And it worked. As US exports stalled due to pricing, tariffs, and broken supply chains, European producers filled the gap. Brussels also ramped up trade diplomacy, signing deals with countries across Africa, Southeast Asia, and the Middle East. These were regions that once relied heavily on American grain and equipment, but now saw the EU as a more stable, affordable, and strategically favorable partner. Latin America rises. Latin America seized the moment too. Brazil, already a major agricultural powerhouse, doubled down on expansion. Its government poured more than $10 billion into infrastructure, upgrading port facilities, building new rail lines, and adding massive grain storage networks. These investments were aimed at solving one of Brazil's long-standing disadvantages: logistics. And they paid off. As U.S. corn and soybean exports dwindled, Brazil surged ahead. It became the world's leading soybean exporter within 2 years and rapidly gained ground in corn. Argentina wasn't far behind, with new government policies slashing export taxes, introducing equipment subsidies, and making farm credit more accessible. Argentine producers flooded the global market. But Latin America's edge wasn't just scale, it was cost. Lower labor and land expenses, fewer regulatory constraints, and favorable currency exchange rates allowed Brazilian and Argentine farmers to sell their crops at prices US